Good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And I'm very excited to share with you what we are going to discuss today, which is a massive backtest that we recently just finished on technical strategies and option strategies on indices and index options, specifically the Nasdaq-100 and the S&P 500. So we're going to go over both in today's session. So before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the securities that we're discussing here today. So we'll start off with just an overview of what we did in terms of the backtest. We'll go over both the technical and options backtest. We'll start by taking a look at the benchmark that we created, just an understanding as to what we utilize to make these calculations. And then we'll go over the details of the technical analysis backtest, the option strategy backtest, and our primary observations that we have made on both. And then we'll talk a little bit about the optimal options parameters that we have found from our backtesting before opening this up for Q&A here at the very end. But the primary thing that I want to help investors walk away from today's session is an understanding as to how you can maximize your returns when you're trading these index options using technical analysis and option strategies. So when we start off, we'll take a look at, like I said today, we're going to look at both the Nasdaq and the S&P 500. So, these are two of the most popular indices that are tracked. For those of you that trade ETFs, you're probably familiar with SPY and QQQ. A lot of investors think of these two indices as very similar to each other because they have very high correlations with each other. There's almost a 95% correlation between the returns of these two indices. However, the actual returns of these two indices could not be more different from each other. If you look at the performance over the past 10 years, the S&P 500 returned a little over 200% return versus the Nasdaq-100 more than double that. So the performance difference between these two indices are quite different. So so when we look at technical indicators, we want to look at both. We want to see not only how does it perform, but how does it perform against a benchmark. So what we really want to understand is how we actually think about these types of indices. So we did both technical analysis backtests where we tested the technical indicators just on the index itself, and then we tested option strategies on those technical indicators to see how well they perform. So the technical analysis side is really trying to gauge the index performance, and the option strategy side is to gauge the option strategies performance. So for the technical analysis side of things, we did backtesting from October 1999 through July of 2021. So almost 21 years of backtesting to test our technical indicators. And we tested our technical indicators across a few holding periods. We went as short as 7 days and to as long as 45-day holding periods for these technical indicators to get a sense for how well they performed against a benchmark. And we tested everything from simple moving averages, exponential moving averages, and most of the popular indicators that traders use for trading to see which ones beat the benchmark, which ones underperform the benchmark. And what we're really looking for is win rate. We're looking for absolute return. And we were also looking at win and loss streaks. It's important to understand these types of data points in order to determine what is the optimal technical indicator to use for trading these types of indices. And then once we had that data, we took that data and we said, okay, you can either buy and hold the trades, or you can trade the options on those strategies. So that's when we did some options backtesting. For options backtesting, there's more limited in terms of historical data. So we went from January 2014 to July 2021, about 7 years of backtesting data. We tested 4 of the most popular bullish strategies. And we only tested bullish strategies because of one very specific reason. As you can see, over the past 10 years, indices for the most part have been very much in an uptrend. There's been no bearish strategies that has outperformed the benchmark. So we only looked at bullish strategies. We looked at 210 different parameters and strike prices, expiration dates, and different combinations of expirations and strike prices to try to find the optimal settings for each one. So for this, we looked at trying to find the optimal setting, meaning what is the optimal expiration date, the strike price, and then we also looked at outperformance against buy and hold. So we're looking at, are you better off just buying the index, SPY or QQQ, or are you better off trading an option strategy on it? Those are the data points that we're hoping to get out of this back test. So before we jump into any of the results, before we jump into any of the conclusions or observations, I first want to show investors kind of the benchmark, because a lot of traders tend to think, especially for those of you that are watching, they think as long as I win more than 50% of the time, that's a good strategy. But what you actually find is that if you just randomly selected random dates to decide that you're going to buy SPY or QQQ, the Nasdaq-100, the S&P 500, what you're going to see is that over different holding periods, your win rates are actually dramatically higher than 50%, which means that if you just randomly selected dates to buy the Nasdaq-100 and you held that trade for 21 days, you would be right 61.5% of the time. And over that period of time, you would return 0.82% on your trade. And so it's really important for people to understand that depending on your holding period and which index you're trading, you actually have a pretty strong win rate just by randomly selecting dates. So whenever we look at any type of option strategies or technical strategies, what we want to do is we don't want to just win more than 50% of the time. We have to beat the benchmark. So these benchmarks were set just by randomly selecting dates and giving a sense for if we held the Nasdaq-100 for 30 days on random dates, we would return on average a little over 1%, and we would be right 63% of the time. On the S&P 500, if on a 30-day holding period, we would actually be right 65% of the time and have an average return of 74 basis points. And every benchmark, every indicator that we tested had to be tested against this type of benchmark. So that's the first part that has to be clear for investors, is that you have to understand what your benchmark is before you look at what the performance of each indicator looks like. So, to look at the data itself, it is overwhelming, but this was the data that we came up with, right? Or based on our back testing we found. I'm going to walk you through it. So on the left-hand side, you have your NDX data for your Nasdaq-100. On the right-hand side, you're going to see the S&P 500 data. So first observation you're going to make is that there are more things on the left-hand side than there are more things on the right-hand side. What that tells us is that there were more strategies on the Nasdaq-100 that beat the benchmark versus the S&P 500, which isn't really surprising because the Nasdaq-100 has better performance. But remember, this is not just beating the S&P 500. This is beating its benchmark. So it seems, at least on first glance, that there are more indicators that beat the benchmark using the Nasdaq-100 than you do on the S&P 500. But let's dive a little bit more so that you understand each one. So what we have are different holding periods. You have for example, the top are the 7-day holding periods. The next one are the 10-day holding periods, and then the 14-day holding periods. That's this column here, right here, holding periods, as you can see down the line, right? As you go further down the line, the longer the holding periods. And within each section, you'll see the ones that are in green are the ones that beat the benchmark. And you have the benchmark here at the bottom. So what you have here is always the benchmark, and you see whether a strategy beats, and everything in green are the specific indicators. And the ones in green are the specific indicators that beat the benchmark for that specific holding period. So that's the first thing, right? And what you're going to have is your, apologies. What you're going to see on your screen here are, your win rates, which I think a lot of investors are concerned about, your average return, and then most importantly, your max win streak and your max losing streak. This is really an important indicator to look at because, Your max win and max losses really help determine your risk tolerances that you can use when you trade these types of strategies. So let's look at some of the observations that we found. There's a summary sheet for this. So for those of you that are watching the replay, when you have the slides, you'll be able to look at the summary sheet. But, first of all, what we notice is that there are more indicators that outperform on the Nasdaq-100 than the S&P 500 for almost all holding periods. And the only exception to this is really the 7-day holding period, where the S&P 500 had more outperforming indicators for the 7-day holding period than the 10-day holding period. And then down here, what we have is also the benchmark versus the average indicator return. And what this was designed to do was to give us a better sense for what is the optimal holding period for these types of strategies. So what we tend to find is that for the Nasdaq 100, you have the most outperformance when you held the trade for 21 days. So the average indicator at 21 days, the average outperformance of indicators at 21 days was 143 basis points. And that's 61 basis points above the benchmark. The 30-day was the highest for the S&P 500, which was 128 basis points versus 74 basis points. That's an outperformance of 54 basis points. But as you can see, the top two holding periods for NDX is 21 and 30, and for SPX is 30 and 21. So this gives us an understanding as to, based on using these technical indicators, what holding period do you have the best outperformance? And for both NDX and SPX, the results were between 21 and 30 days, and these are calendar days. And what we did is we tested EMAs, we tested SMAs, we tested EMAs, short-term, long-term EMAs, and everything from 20 days to 200 days. We tested most of the major indices, major indicators like RSI, stochastics, MACD, CCI, and what you notice on this screen is that the number of indicators that beat their benchmarks predominantly are moving averages. You don't see a lot of you see some RSI, you see some MACD, you see a few CCIs, but for the most part, you also have William percent R, you also have KST, which is no sure thing, another kind of obscure indicator, but we really threw quite a few different indicators at the back test. And again, what you see is that most of the indicators that beat the benchmark are moving averages. So a couple of notable observations. One, the best performing strategy was RSI 20, meaning a 20-period RSI crossing above the 25 threshold, the 25 threshold and the 30 threshold. Both of those are oversold thresholds on RSI. When those crossed above those oversold thresholds, they generated the highest absolute return than any other strategy. There is one caveat to that one indicator, is that they generated very few signals. For the most part, they generated relatively few signals, but they had very high returns. It is for pretty much all holding periods, the RSI was the best performing indicator, but it generated very few signals. So I don't know that it's as useful for most investors. But when you do see that SPY QQQ RSI 20 period go below 30 or go below 25, that is one of the strongest buy signals that you can have on the overall market. One of the other observations that we made comes down to moving averages. We get a lot of questions from investors, which moving average do you use? EMA, SMA, what type of moving average? From our research, when you're trading indices, meaning specifically, an index that has a lot of constituents, EMAs outperformed SMAs. And this is kind of the reverse that we have found when we backtested individual stocks. We tended to find that individual stocks perform better with SMAs or simple moving averages, and EMAs perform better for indices. So exponential moving averages perform better for indices, and simple moving averages perform better for stocks. And which moving average performed the best was actually a bit surprising to us, because I remember from our backtest on stocks, the 50-period moving average was generally the best performing SMA for stocks, simple moving average for stocks. But when we look at the indices, we tended to find that the very longer dated moving averages, the 100-day and the 200-day, actually outperformed the shorter period moving averages, exponential moving averages. And that was quite interesting. And I don't really have a good explanation as to why a 200-day moving average would have such good performance on such small holding periods. So if you're going to hold something for 14 days, why does the 200-day EMA outperform the 100-day EMA? My only guess to that is because there's probably way more participants, money managers, investors, traders such as yourself that follow the 200-day moving average and the 100-day moving average. And whenever a major market crosses that 200-day moving average, there's a lot of eyeballs, if you will, on it, and likely that will juice initial performance very quickly in the very short run. And that's my only real way to explain why EMA 200 outperforms all of the shorter period EMAs, which you would think would perform better on these short-term holding periods. But the long-term EMAs do perform better here when we're trading indices. And again, this is only specific to indices, the Nasdaq-100 and the S&P 500. We did a separate backtest on stocks, and the observations from stocks and indices are different from each other. The one thing I do want to point investors to is the fact that the max loss streak, the maximum number of consecutive losses in a row for the Nasdaq-100 and the S&P 500, they were fairly high for a lot of strategies, which means that you have to account for this in your trading. You have to account that if you're going to follow these types of strategies when you're trading index options, that at some point you might come across 5, 6, 7, 8, 9 losing trades in a row. And you better have the risk tolerance or the ability to suffer through those losses in order to reap the gains. The gains are there. Our backtest shows you there are long-term gains in these strategies, but those long-term gains are only there if you can suffer through the losses and not have these consecutive losses blow up your account. We see too many investors who will trade these types of strategies based on this data. They can see the data shows that there are positive returns, but when they risk too large and they come across a string of losses and those losses blow up their account, you no longer have the capital to be on the other side and reap the gains once the strategy does become more profitable. And that is a very, very important observation that we have made from this backtest. And I think it's very important that everyone who's watching this today understands that, because everything that we're doing here is for nothing if you risk too large of your portfolio per trade, so that when you come across those consecutive losses that you blow up your account and you can't continue trading anymore because you don't have enough capital to continue. So it's very, very important that you take that piece of data with you on your trading. So this is kind of just a quick summary of the things I explained here before, and I'm not going to go over it again. This is more for you when you're watching the recording. If you're downloading the slides, you have a reference point of these primary observations that we have made from trading index options. Predominantly it's the moving averages that are the best indicators for trading indices. But in the rare event that RSI generates a buy signal, those are very strong buy signals that have very strong returns. They are rare, but they are ones that you want to pay attention to. And then, focus more on the longer period EMAs. Those are the ones that have performed historically the best performance on these types of strategies. So onto that data, what we then did is took that data and plugged it into an options backtester. We built our own options backtester, and we basically tested 4 different strategies: long call, long call, debit spreads, short put, credit spreads. Those are the 4 bullish strategies that we tested. And what we did is we looked at which option strategy outperformed the buy and hold benchmark. And remember, the benchmark here for NDX is much higher than the benchmark for SPX because, like I said, NDX has had a substantially better run over the past 10 years than the S&P 500. So the bar that was set for the Nasdaq-100 was substantially higher. Every option strategy had to outperform an annualized return of 9% versus the S&P 500 only had to perform an annualized return over 5%. So what we did is we tested long calls. We tried a bunch of different expiration dates, a bunch of different deltas. We tried 30 delta, 50 delta, 70 delta. We did the same thing for short puts, 30, 45, 60 days, tested a bunch of deltas. And then we also tested debit spreads and credit spreads to see if we can improve returns on buying the call and improve the returns on selling a put using a debit and credit spread. We tried different expiration dates, different combinations of strike prices, and this is the result of all of that data. And again, I'm going to walk you through the output of these results and kind of what our primary observations are. But what you clearly see is that there are more trades on the right-hand side of your screen for SPX than there are for NDX on the left-hand side of your screen. And again, this is because the SPX benchmark was so much lower. So there was just simply more option strategies that outperformed the benchmark than on NDX. And then when you look at this data, just to show you how to read this data, for each one, what we had was for each strategy is a table. Within the table, you have the different expiration dates, the different targets in terms of deltas for the strike prices, and then you have annualized return, which is an important column, and then you have win rate, which is another important column for investors. And we also see the win streak and the loss streak on each trade. So these, annualized return, annualized return and the win rate are probably two of the more important ones. And then what you want to see is kind of where you have the best returns, the best win rates, and kind of optimize around each one. And what we use is different indicators such as the EMA 100 period, which is one of the best performing technical indicators to trigger the actual buying of these calls. So we use the same triggers. And what we did is we tested, instead of buying the 30-day call, we buy the 60-day call, which one performed better. Or if we use the same trigger, we use the 30-day call, we compare the 30 delta to the 50 delta to the 70 delta. And the goal is to say, okay, now that we have all these technical indicators that outperform the market, how do we then outperform those indicators by using option strategies rather than buying QQQ or SPY, the ETF itself? And these are the primary observations that we made. So first of all, out of the money call option. So when you buy a 30-day, 30 delta, which is an out of the money call option, this gives you the highest annualized return of basically any strategy, 13.74%. However, this is also the strategy with one of the lowest win rates. Only 39.57% of the trades ended up being a winner, meaning 60% of your trades lost money. And the most difficult part to swallow about this strategy, and a lot of investors who buy out of the money call options will relish in the fact that this is the strategy with the highest return. But the biggest warning signal that I will tell you is that the biggest win streak it had was only 6 trades. And the biggest losing streak it had was 27 trades. I would say that this is one of the hardest strategies to execute in the long run because of how skewed that win ratio and win to loss streak is. Meaning in order to actually get this 13.74% annualized return, you have to make sure that you risk such a small percentage of your account that you can suffer through those 27 consecutive losses to make it on the other side. And this strategy, really, the characteristic of this strategy is that you basically lose most of the trades that you place, and then you have a few big home runs that basically make up for all of the losing trades that you have. It's a really tough strategy to make money from in the long run, again, because of how often you lose and the fact that you have such long streaks of losers that you have to suffer through and survive through before you can reap this 13.74% return. And I tend to find a lot of investors can't quite do that. So one of the better observations that we made is that you can do the same 30-day 70 delta in the money call option. So instead of buying an out of the money call, or let's look at the same trigger, the 100-day EMA. So you're buying this when the Nasdaq-100 crosses above the 100-day moving average. And what we're comparing is buying the 30-day out of the money call option versus buying a 30-day in the money option, the 70 delta call. And what you can see is that the annualized return is certainly lower, right? It goes from 13.74% down to 11.57%, but that's still better than the annualized return, meaning if you just bought the NDX as a buy and hold strategy. But notice the win rate here, 66.91% of trades were winners. So this is going to cost you a little bit more to get into the trade because in the money options are more costly, but you win 67% of the time. And more importantly, your largest win streak was 10 winning trades, and your biggest losing streak was only 7 losing trades. So what you're doing is you're transferring a couple of percentage points of return in exchange for a strategy that's far more survivable and far more capable of you being able to suffer and survive through the losing streaks to be able to reap the 11.5% return. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. This is one of the kind of the biggest observations that I made from this data set that I think is important for investors to walk away from. And this is not necessarily you're going to see the same stats when you're trading stocks, but you're going to see this is a more extreme when you're trading index options. Those in the money options will have far higher win rates and will have far fewer consecutive losing trades in exchange for what is relatively small give up, if you will, in absolute performance. Okay, so then what we looked at is, can you possibly improve on this? Can you perhaps get a best of both worlds, right? How can you have something like these types of win rates with perhaps a higher return that you have within the money call, out of the money call options? And that's really where debit spreads came into play. As you can see, if you buy every time the Nasdaq-100 crossed above its 100-day moving exponential moving average, you bought a 30-day debit spread, and a debit spread is where you buy the 50 delta in the at the money call option, and then we sold the 20 delta call option against it. What you start to see is that the annualized return here is almost identical to buying out of the money call options. It's 13.7% versus 13.74%. But look at the win rate, 60.43% win rate. And as you can see, a win-loss streak very similar to buying the in-the-money call option. So these two stats look quite similar to each other. So you get kind of the best of both worlds. You get the risk management of the in-the-money call options, and you get the returns of those out-of-the-money call options. And this is really where debit spreads shine in this particular index options world, where you can get the win rates and the consecutive losing streaks that are much lower compared to the similar to in the money options, but the returns that are much closer to those out of the money call options. Does that make sense, everyone? Please type 3 into the chat window if that makes sense to you. And just so you know, when we look at annualized return, we only annualize the returns so that we can compare different holding periods, apples to apples, right? So we are actually calculating absolute return, and then we're annualizing those absolute returns so that we can compare them apples to apples. Otherwise, you wouldn't be able to compare a 30-day return to a 60-day return. We always annualize it so that we can compare them side by side. Okay, and these are all bullish strategies. Again, when we're talking about indices drift higher here, as you saw in the first benchmark, 62 to 65% of the time the markets move higher here. There's no bearish strategy. There's no systematic bearish strategy that makes money on indices just because of that upward drift. So we're only testing bullish strategies. Next, we want to take a look at short puts. Now, this is the only strategy where there were no short puts that beat the NDX benchmark. And again, that's because the NDX benchmark was too high, 9%. No short puts were able to generate 9% annualized return. Only on the S&P 500 were we able to beat the 5% annualized return on the S&P 500. So when we look at short puts, this is the strategy with some of the lowest annualized returns. So if you sold the put every single time the S&P 500 crossed above its 100-day exponential moving average, you had an annualized return of about 5.8%, which is basically the index annualized return. But you did have a very strong win rate. This is the highest win rate of any option strategy we tested. 81% of the time, when you sold a 45-day at the money short put, a 45-day at the money put, that's where you won 81% of the time, and you average a return of 5.8%. So high win rate, lower return, low win rate, typically higher return, right? So that's kind of the relationship that you have. So when you have a very high win rate, you're generally going to have a slightly lower return. But the losing streak here was really impressive. 30 consecutive wins was the longest win streak. Three losing trades was the biggest losing streak. So you have a very high win rate and a very low probability of seeing large number of losses in a row. So short puts was very promising, just returns were relatively low. But that's really where we started to see credit spreads shine, right? We don't really have a good benchmark for NDX because the short puts didn't beat the benchmark, but we can compare the SPX to the Nasdaq-100, right? So here you have a 5.8% return with an 81% win rate. So what we tried to do is we tried to see if same thing, just like with a long call, can we use a debit spread to get kind of the best of both worlds? We tried to use credit spreads and do the same thing. So what we did is we sold the 30-day, same thing, EMA 100 trigger. We sold the 30-day 45 delta, 25 delta credit spread. So we sold the 45 delta and then we bought back the 25 delta. And what you see here is that you get an annualized return that's much higher, 9%, a little over 9% versus the 5.8%. So you get a significant boost to outperformance in terms of annualized return. And in exchange, you are giving up a little bit on the win rate, but not by a whole lot, right? So you reduce your win rate from 81% down to about 75%. But as you can see, your win streak and your losing streak are very similar to each other, but you have this nice bump in terms of performance. And we see the same thing here for credit spreads on NDX. Here, we sold the 30-day 25-45 delta credit spread. We had an annualized return of 9.87%. We had a win rate of 77%, a win streak of 20, and a losing streak of 5. So much easier to survive, in a 7-year period where the largest losing streak that you had was 5 losing trades in a row. Those are much easier to plan for than when you have strategies that perhaps lose 14 losing trades in a row, 15 losing trades in a row, or 27 losing trades in a row. 27 is obviously a bit of an extreme here. As you can see across the entire strategy, there are not many other strategies that have that many types of losing trades, but it does happen. And it's important that you understand that because that is a very critical element to selecting your strategy. Unfortunately, I see too many investors that look at this number alone, or they look at numbers like this alone and they select strategies based on just win rates or just annualized return, not really noticing how many consecutive losing trades they have to suffer through in order to generate these types of returns. And many times those losses or the consecutive losses are so large, it's really quite difficult to get through them in order to be profitable. So, here's another quick summary of what I just spoke about here. Again, this is for you when you watch the recording and when you download the slides to have these observations, but those are what I just went over with you here today. Basically, the fact that buying out of the money options have the highest return, in the money had the best win rate. Debit spreads was able to combine the best of both worlds for the out of the money and in the money calls. And then when you sold puts, you had a very high win rate, but a very low return. And you can simply improve that by selling credit vertical spreads on those to get a slightly lower win rate, but a much higher bump in terms of performance. So, based on all of the back tests that we did across all of the different expiration dates, what we settled on is for index, and specifically these optimal strategies are for indices. When you're trading a long call, 30 days to expiration, 70 delta in the money call options have the best optimal strategy for index options. When you're selling a put option, 45 days to expiration, selling the 45 delta, which is just the first out of the money strike price on an index. When you're buying a debit vertical spread, anywhere from 30 to 60 days, we found there was good performance in 30, 45, 60, very similar performance across 3 expiration dates. But the strike prices, buy a 50 delta call, meaning a slightly in the money call, and then sell a 20 delta call against that. So just inside of 1 standard deviation is the optimal options, strike price for selling buying a debit spread. And then when you're selling a credit spread, the optimal expiration for indices was 30 days to expiration, and selling the 45 delta, which is the first out of the money put, and then buy a 25 delta put against it to offset your risk and cap the risk that you're taking on these types of trades. So that covers what I wanted to share with you here today. And for those of you that are thinking about using these types of strategies in your portfolios, the one thing I want to introduce for those of you that may not be familiar is that when you're trading these products, there are different contract sizes that are available to you. You can trade the full NDX, which is what we did the back testing on. And we did it because the NDX has the most historical data sets in order for us to test on. But there are 2 other indices that are identical to the NDX, but smaller contract size that may be better suited for you if you are going to execute these strategies on your portfolio. There's NQX, which is 1/5 of the value of the NDX, and there's XND, which is 1/100th of the value of the NDX. And the reason these products are here is because the NDX is a very large contract. At $13,500 index, that's a $1.35 million contract. A single contract is $1.35 million. Too big to trade. But you can trade the 1/5 value index, which is NQX, $270,000 contract. Still, I find for many traders that are watching today, it's too large. So if you have a smaller account, you might want to look at XND, which is $135, 1/100th of the NDX, so a $13,500 contract. And if you're trading spreads on these, you can minimize your risk down to just a few $100s per contract. So for those of you that are maybe new to index options, or if you're trading index options and this presentation gave you some different ideas or different strategies that you might want to deploy, make sure that you select the index product that suits your portfolio, because the NDX may be too large for your portfolio. So you might want to look at NQX or XND depending on your portfolio size. So for those of you that are first-time watchers of OptionsPlay, I just want to say welcome and thank everyone for taking the time out here this afternoon. I hope that this was helpful in giving you a better understanding of the technical strategies and the option strategies that you can trade on the Nasdaq-100. You can sign up for a free 30-day trial of OptionsPlay if you don't currently already have access at optionsplay.com. You're going to get access to our daily entry and exit trading signals, our weekly options education sessions like the one that I'm hosting here today, as well as access to our full OptionsPlay platform so that you can analyze these NDX, NQX, and XND strategies in your OptionsPlay account using our tools. And for everyone that's watching this webinar, or anyone who's watching the recording of this webinar, when we send out the recording to you, we'll include the recording of this video. We'll send you the slides, and we'll also send you a link to download the full report, the full technical analysis backtesting report. We've published this report for everyone so that you can download. That will be available in a couple of days. So we will send you everything, the recording, the slides, and how to download the full report so that you can read through and look at the data on your own. So with that, that covers what I wanted to share with you here today. Hopefully this was helpful. At this point, what I will do is I'll open this up for Q&A. I have a few minutes for a Q&A section before I have to jump, because I am on options action and fast money in a few minutes. And I hope some of you will be able to catch that here at about 5:15, 5:20 when I am on. Why do your spreads go out 2 months? Why don't you use 2-week spreads? It's mostly based on our back testing. We tend to find that the 2-week spreads also have a very high number of consecutive losses. At some point, and it may not happen today, may not happen next month, but when you're trading 2-week timeframes, you tend to have a large number of consecutive losses at some time, and those are really difficult to suffer through and survive to be able to be profitable in the long run. When you do back tests, how far do you go? I think I covered that. Why do you not test more than 45 days? Well, for these types of strategies, you'll tend to find that as you go further out in time, they're going to actually underperform in terms of the strategy, right? If you're buying, they become too expensive. If you're selling, you're not capturing enough time decay per day. So that's why we tend to find that 30 to 60 days is kind of your sweet spot, whether you're buying or selling. Should you annualize the average indicator return to determine which one is best? We do that. All of these are based on annualized returns when you look at these trades. Oh, I'm sorry. Do we annualize the returns? No, we do not. But that's why we did this analysis. We did the average return versus the benchmark return for each time frame, so that you can understand which time frame had the best outperformance. And it was 21 and 30 days for both the S&P and the Nasdaq. Have you done the same analysis for cover calls? We have not. And the reason for it is because you can't trade a cover call on an index because you can't own the index. So that's why we haven't tested this on cover calls. Let's see. Is it not MACD derived from SMA? MACD is derived from SMA. That is correct. But as you can see, MACD did not make the list too many times. It made it on the 10-day, the 14-day. It did make it on the 30-day. So MACD is here. There were plenty of MACD signals that did outperform the benchmark. But the one thing I will say is that they barely beat the benchmark, right? So here, 3 basis points. Here, 1 basis point, here was 2 basis points. So MACD just barely beat the benchmark. So basically what we're saying is that you can randomly select buying the Nasdaq-100. And if you compare that to using MACD, every time it generated a buy signal, those two were almost identical in terms of performance. So you don't have a lot of outperformance here from MACD and a lot of the technical indicators. It's really RSI, and then the EMAs are really the ones that have any significant outperformance versus randomly selecting dates to buy the Nasdaq or the S&P. The 100 and 200 EMA crosses and touches on the two indices should probably be very rare, right? So let's just take a look, right? So for example, the EMA 200 crossed over 73 times in that 20-year period, 142 times in that. So not too rare. 142 times is still multiple times, a few times a year that you'll generate those types of signals. I don't see a column showing how many trades for each period. So this is the number of trades that were traded in each period. So there is that column there. Do you have any max drawdown data in your back testing? So that's exactly what this max loss streak was meant to do, right? It gives you a sense for their max drawdown. And the max drawdown is depending on how much you are risking per trade, but we're telling you how many consecutive losers there are. So if you're risking 2% of your account per trade and you have 5 losing trades in a row, that's 10% of a max drawdown, right? So you can calculate your max drawdown based on what percentage of your portfolio you would risk on one of these trades. Let's see. How do I download the slides? So when we upload to YouTube, the slides are always available to download in the description, but we will also send you a recording with the slides for you to download. How were these trades managed? These trades were not managed. They were just holding for the specific holding period. That's it. These were simple back tests. These were not, this was meant to give you the data, to give you a sense for what direction to head in. You can do further optimization to try to find the best return, but this wasn't about finding the best return. This was finding about the relationship of in the money, out of the money call options. Which one is best? What kind of relationship should you expect between returns and wins, or win rates, if you will? Debit spreads, credit spreads. What does it improve? What is it? What do you have to give up for these? So that's really kind of what we were hoping to get at. And then you can always further, the research, if you will. But this was to give you that high level, not kind of that nitty gritty deep down, if you will. HP is holding period, the average holding period, because the target is 30 days, but you don't always find exactly 30-day options. So the HP refers to the holding period, the actual holding period that we were able to collect on these types of strategies. How to control risk when short SPX if index drop dramatically. A credit spread is the best way to control your risk, right? You're able to significantly reduce. So as you can see, the worst trade was down 421% when you're short the put. The worst trade on the credit spread was only down 290% on the trade. So that's one of the best ways, in my opinion, to reduce risk on short SPX puts, is to use a credit spread. Do you hold to expiration on all of these trades? Yes, these were all holding to expiration. These were not optimized. Again, this was to determine the relationship between these strategies and give you a sense for which, what type of returns can you expect, what type of risk can you expect, and the relationship between them. You can further optimize them and maybe eke out a few extra 10, 20 basis points if you were optimizing them, but you're not going to see drastic changes by further optimization. You're going to see much smaller changes by, maybe exiting the trades early, managing wins, managing losses, but those are going to be small changes. This is kind of at a high level what you can expect from these strategies. What options play tool flag these EMA triggers on these indices? So Pat, great question. What we're currently in the process of developing a far more, scanning capabilities and giving you real-time alerts of what things are happening. So those are some of the things that we're currently working on and generating these types of alerts so that you can get a sense for which stocks are crossing above, certain moving averages, which stocks are crossing below some certain moving averages, so that you'll be able to see those triggers in options play. So we have tested, short 20 delta puts on weekly options. The concern is less so on the returns and more so on the risk side. So Mark, I'll try to see if I can dig some of that stuff up. On the NQX and NDX, I've tried trading these, but the open interest is not very good. So the open interest is not very good, but keep in mind the underlying is the same as X and D. So the liquidity is there. But open interest is not a good sense for liquidity. These are new products. New products will naturally have low open interest. Everything has to start with zero open interest. That's part of why we're doing this education, is so that you understand that these products are there. The more you trade them, even in the few months that I've been doing X and D education, I've seen the spread come down. I've been able to execute them very close to midpoint on all of my trades on X and D. So you might see zero open interest, but you will see fills very close to the midpoint, because these are some of the most liquid products in the world. Keep in mind, the underlying is the Nasdaq-100. The Nasdaq-100 is one of the most liquid products in the world, trades about $40 billion notional every single day. So if you're trying to execute a trade for a few $1,000s, if tens of thousands of dollars, even hundreds of thousands of dollars at a time, with a $40 billion notional values traded every single day on the Nasdaq-100, you should not have any problems getting your orders filled. Certainly liquidity is not the problem if that is the case. Would these strategies only work on the indices or also on ETFs and equities? They would work on ETFs. They would not work on equities. I've done a whole separate backtest on equities, and you can find that in our YouTube channel as well. And index options are cash settled, and they are European style as well. So yes, but this strategy is generally only for index options, not for stocks. But I do have a whole separate back test just on stocks alone. I have time for just a couple of more questions. Although you have discussed before eloquently on liquidity versus open interest, when you look at SPX OIs and volume are big and NDX is small, that's scary. So open interest and volume has really nothing to do with your trading. I mean, when you say it's scary, I'm curious to say, I'm curious to understand what's scary about it. Because, again, the Nasdaq-100 trades about $40 billion in notional value every single day. If you're concerned that your $10,000, $20,000, $100,000 order, even $1 million order is going to be even a drop in the bucket, what I want to communicate to you is that you will never, ever even come close to tapping out the liquidity of the Nasdaq-100 as a retail trader. So don't ever be afraid of liquidity when you're trading some of the most liquid products in the world. For the different strategies, and also you also have to think about performance, right? Look at the performance difference between the Nasdaq and the S&P. Hopefully, this highlights to you some of the performance difference that you will see between the two strategies or the two indices. How much of your portfolio would you allocate to these index option strategies? Very good question. The answer on that is answered by this particular column. The higher the number, the lower you can allocate per trade to that type of strategy. The lower that number, so if you're looking at these types of credit spreads, you can allocate a larger percentage of your portfolio to per trade, because you don't have to suffer or survive through such a large number of consecutive losses in a row. But if you're trading out of the money call options, you better risk a very small percentage of your account per trade, because at some point you're going to have a very large number of losses in a row. With that covers what I have time for you here today. And I unfortunately have to jump. I am on CNBC in a few minutes. I look forward to seeing some of you on there as well. So thank you so much. We will send out the recording, the slides, as well as the download to the full report as soon as it's ready. Thank you so much and have a great afternoon.